I think the market is taking some hope from the silver lining that once President Trump as well as President Xi Jinping do meet during the G20, things may look up. Paul Dietrich is CEO and Chief Investment Officer at Fairfax Global Markets. He joins us from New York. Paul, it's great to have you in the show. Thanks very much for staying up for this interview. Your sense, do you think the markets are pairing losses, and that's what we are seeing with the U.S. futures, primarily reading between the lines that there is still hope against hope that a deal could happen at the G20?
Well, you know, what's happening right now is kind of what we call a political correction in the United States. We saw this in November and December where the market went down because of the government shutdown and trade tensions, all sorts of political issues that have nothing to do with the underlying U.S. economy. And I think the same thing is happening right now, and we're going to see a lot of volatility over the next month and a half. I think investors have to look at two dates. One is June 1st in a couple of weeks. That's when the tariffs on both sides actually kick in, and we'll see whether there's any progress in the talks by then. However, the more likely scenario is that it's going to be June 28th and June 29th during the G20 summit, where President Xi and President Trump are going to be meeting. And I think, you know, both of these men have enormous egos, and I think they're going to want to have an agreement by then. They will look to the rest of the world like both of them will look like failures if they walk away from that G20 summit without any agreement whatsoever. So my guess is that's going to be the interesting date. That's when we're going to see some sort of compromise, because you have to remember that this deal was pretty much all done. People thought it was going to be signed last week, and as a negotiating tactic, the Chinese came in and backtracked on, for the Americans, what was the most important issue was the enforcement mechanisms. And I believe there'll be some compromise on that, and we'll see this come to a head in June 28th and 29th. However, there's going to be a lot of volatility in the market until then.
So let's talk about that, Paul. I mean, we've seen the way the Chinese markets have reacted very negatively. They far outpaced U.S. ones, but now we're starting, I think, to see the pessimism getting priced in. 10 years sub 240, yield curve short end inverted. Fed funds futures are now pricing fully a 25 basis point cut for coming up in December.
Well, that will only take place if, in fact, that we don't have a trade agreement June 28th and 29th. If we don't have a trade agreement then I believe that Congress will put on massive subsidies to farmers. It's the one subsidy both Republicans and Democrats love. They're going to match whatever harm that the farmers are getting through subsidies, and I do believe there will be a federal rate cut if that happens. But boy, both economies, but primarily the Chinese economy, is going to be really hurt if there isn't some agreement at the G20 summit. Again, everything had been agreed to by both parties, and then the Chinese backtracked, I think, as a negotiating tactic. And you know, I just don't think that it's going to go beyond that, or both President Xi and President Trump are really going to look like failures on the world stage and right in front of President Putin.
Right, Paul, but in the interim, you know, how do you see the dynamics of exerting pressure on each other would play out? Because now, you know, the markets are talking about that big treasury pile-up being offloaded by China, and that could be a big possibility, a big overhang for the markets. Add to that the leverage they have with the yuan devaluation, sparking off fears of a potential currency war.
I just don't believe that will happen. You know, the Chinese, investors don't understand this. The Chinese do not keep large amounts of U.S. treasuries because they're nice guys. They have to use all of those treasuries that they have. I mean, everything in the world that they buy in commodities, oil, everything is priced in dollars, and they have to pay for dollars. They get dollars from imports that they have to put into U.S. treasuries, and the Chinese manipulate their currency by pegging it to the U.S. dollar. And in order to manipulate their currency the way they like to do it, they need to have a fair amount of U.S. treasuries. They can't dump U.S. treasuries. And if they did, again, if they started to do that, they would just hurt themselves because the value of their own U.S. treasuries would go down. I don't believe that they will do that, not because it just doesn't make any sense. They would be destroying their own economy.
Okay, Paul, a lot more to talk to you about. Stay right there. Paul, Dietrich live stateside.